What if the next life-changing stock, the kind that could multiply your money tenfold, is already right in front of you? Picture this: you're walking into a coffee shop, buying sneakers or scrolling on your phone, and you're one of the first people in the world to notice a product or brand exploding in popularity. While Wall Street analysts are buried in spreadsheets, you're living in the real world where the future actually shows up first. Peter Lynch, the legendary manager of Fidelity's Magellan Fund, built his career on this exact idea. He turned everyday observations into billions of dollars, achieving returns that crushed Wall Street 29% per year for over a decade. And here's the shocking truth: you don't need to be a financial genius or have insider connections. You already have the tools to spot the next 10-bagger, a stock that multiplies by 10 before the professionals catch on. In this video, we'll break down the 6 timeless lessons from Lynch's classic One-Up on Wall Street. You'll discover why ordinary people actually have an edge over Wall Street, how to find companies with explosive growth potential, and how to hold on long enough to let your winners change your life. So if you've ever dreamed of spotting the next Amazon, Apple, or Tesla, stick around. By the end of this video, you'll know exactly how to start thinking like Peter Lynch. Why ordinary investors have the real advantage. Wall Street wants you to believe the game is rigged in its favor. They've got billion-dollar research budgets, trading floors buzzing with analysts, and supercomputers crunching numbers all day long. But Peter Lynch argued the opposite. The real edge belongs to you, the ordinary investor. Why? Because you live in the real world. You see the new restaurant that's packed every weekend. You notice which clothing brands teens are suddenly obsessed with. You hear from friends about the app they can't stop using. By the time Wall Street's reports finally confirm the trend, you've already been watching it unfold in real time. Lynch called this scuttlebutt, paying attention to what's happening around you before it shows up in earnings calls or analyst notes. He believed that spotting these everyday signals early gave individuals a unique window into the future. And here's the kicker: you don't need to predict everything perfectly. You just need to notice the right story now and then, because one 10-bagger can make up for dozens of small mistakes. So if you've ever thought investing was only for the experts, think again. Your everyday experiences might already be your most powerful investment tool. But how do you turn those observations into actual smart investments? That's where Lynch's first big principle comes in. Invest in what you know. Principle 1. Invest in what you know. Peter Lynch's most famous rule is deceptively simple. Invest in what you know. Think about it. If you're already a customer, fan, or early adopter of a product, you probably have insights Wall Street doesn't. You see trends long before they hit the financial news. Lynch proved this with companies like Dunkin' Donuts. He wasn't just reading reports, he was walking into stores, tasting the product, watching lines of customers wrap around the block. To him, that was evidence of strong demand. The logic is straightforward. If millions of people love a company's product, its business has room to grow. And if you're part of that customer base, you're one of the first to notice. But here's the catch: invest in what you know doesn't mean blindly buying stock in your favorite brand. It means using your personal experience as a starting point for research. Once you spot a promising trend, you still need to dig into the numbers: sales growth, profits, debt, and long-term potential. This principle empowers everyday investors to stop chasing Wall Street tips and start trusting their own eyes and instincts. You don't need a fancy degree. You just need to pay attention. So ask yourself, what's one product, store, or app you've seen explode in popularity that most people haven't noticed yet? That could be your first clue. But not all companies are created equal. Lynch broke the market down into 6 categories of stocks, and knowing which type you're buying is the difference between smart investing and gambling. Principle 2. The 6 types of stocks. Peter Lynch believed that before you invest in any company, you need to know what kind of stock it is, because buying a fast grower like Starbucks isn't the same as buying a slow, steady utility company. He divided stocks into 6 categories: slow growers, mature companies with limited growth, such as utilities. They won't make you rich, but they provide stability and dividends. Stalwarts, large, established firms such as Coca-Cola or Johnson & Johnson. They grow slowly but steadily, perfect for holding during uncertain times. Fast growers, small, aggressive companies expanding quickly. These are the potential 10-baggers, but also carry a higher risk. Cyclicals, companies tied to the economy's ups and downs like airlines or car manufacturers. You can profit if you buy them at the right point in the cycle. Turnarounds, troubled companies that might bounce back if management or market conditions improve. High risk, but sometimes high reward. Asset plays, companies whose hidden value lies in assets, like real estate or patents that the market hasn't recognized yet. Lynch's advice was simple: don't confuse one type for another. If you treat a slow grower like it's a fast grower, you'll be disappointed. And if you hold a cyclical through the wrong part of the cycle, you'll get crushed. This framework gives investors clarity. Once you know what bucket a company belongs in, you can set realistic expectations and avoid painful mistakes. So here's the big question. When you look at your portfolio or even your watch list, can you honestly say you know which category each stock falls into? Because recognizing the type of stock is just the first step. The real money is made when you find that rare gem, the stock with the power to multiply your investment tenfold. And that's where Lynch's most exciting principle comes in: the 10-bagger philosophy. Principle 3, the 10-bagger philosophy. If there's one idea that made Peter Lynch a legend, it's this. The 10-bagger, a 10-bagger, is a stock that increases tenfold in value, turning $1,000 into $10,000 or $10,000 into $100,000. Lynch's Magellan Fund didn't crush the market because he picked every stock perfectly. In fact, he admitted he was wrong plenty of times. The secret was that just a few 10-baggers covered all the mistakes and created staggering returns. The beauty of a 10-bagger is that you don't need dozens of them. Even one or two in your portfolio can change your financial life forever. Think about early investors in companies like Apple, Amazon, or Netflix. Those were classic 10-baggers hiding in plain sight. But here's the challenge. Spotting them is only half the battle. The real test is having the patience and conviction to hold on while the stock grows. Most investors sell too early. They take a small profit and move on, missing the chance to ride the wave of exponential growth. Lynch's philosophy was clear. Once you've done the research and believe in the company's story, give it time to play out. A true 10-bagger doesn't happen overnight. It can take 5, 10, or even 15 years. So the next time you find a company you believe in, ask yourself, are you willing to hold on long enough to let it become a 10-bagger? Because without discipline and research, even the most promising stock can slip through your fingers. And that brings us to Lynch's next lesson: why common sense and homework matter more than Wall Street hype. Principle 4. Do the research, use common sense. Peter Lynch loves spotting opportunities in everyday life, but he never stopped at just liking a product. His golden rule was simple: do your homework. Wall Street often overcomplicates investing with endless jargon, complex models, and shiny presentations. Lynch cut through all that noise. He believed that a little bit of research, combined with common sense, was more powerful than any fancy formula. Here's what he looked for. Earnings growth. Is the company consistently increasing its profits? P/E ratio. Is the stock priced reasonably compared to its earnings? A high-flying product with an insane P/E might already be overvalued. Debt levels. A company drowning in debt can collapse even if its sales are strong. Simple story. Could he explain in a sentence why the company would keep growing? If not, it wasn't worth investing in. He used to say, never invest in an idea you can't illustrate with a crayon. Think about that. If you need a 20-page report to justify a stock, it probably isn't a good pick. However, if you can point to a clear story, such as this company keeps opening new stores and every one of them is profitable, that's the power of common sense. The big mistake most investors make: they either skip research entirely, buying stocks based on hype, or they drown in details and forget the simple, obvious truth. Lynch's approach is the middle ground. Find a story you understand, back it up with a few key numbers, and then let patience do the rest. And patience, as Lynch reminds us, is the most overlooked investment skill of all, which leads us directly to his final lesson: the power of long-term discipline. Principle 5. Long-term patience and discipline. Here's the uncomfortable truth. Most investors don't fail because they pick the wrong stocks. They fail because they don't stay invested long enough in the right ones. Peter Lynch warned that the market will constantly test your patience, Prices rise and fall, headlines scream doom, and friends brag about quick wins in trendy stocks. The temptation to sell or to chase the next hot pick never goes away. However, history shows that the greatest rewards often go to those who remain steady. Think of Amazon in the early 2000s. After the dot-com crash, its stock fell by more than 90%. Most investors bailed, but those who had the discipline to hold or even add more saw Amazon become a life-changing 10-bagger many times over. Lynch's advice: ignore the noise. Don't obsess over daily price moves. Don't let fear or greed dictate your strategy. Instead, keep your focus on the company's fundamentals. Is it still growing? Is its story intact? If yes, stay the course. He believed that a portfolio doesn't need to be constantly tinkered with. It requires conviction and patience. Because the real power of investing is compounding, and compounding only works when you give it time. So ask yourself, do you have the discipline to let your winners grow? Because in the end, patience isn't just a virtue, it's your greatest financial edge. And that brings us to the big picture: how these 6 timeless principles from One Up on Wall Street fit together and how you can use them to build real wealth. Let's recap Peter Lynch's timeless wisdom from One Up on Wall Street. Ordinary investors have the edge. You see trends in real life before Wall Street does. Invest in what you know. Use your everyday experiences as clues, but always back them up with research. Know the 6 types of stocks: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. Each play a different role. 10 baggers change everything. You don't need dozens, just a few winners can transform your portfolio. Do the research, use common sense, look for earnings growth, manageable debt, and a simple story you can actually explain. Be patient and disciplined. Hold on through the noise and give it the time it needs. Here's the truth: you don't need to be a Wall Street insider to win at investing. You just need to open your eyes, trust your everyday observations, and combine them with patience and discipline. So here's my challenge. What's one product, store, or app you've noticed that seems to be exploding in popularity but hasn't hit the mainstream yet? Drop it in the comment. I'd love to see what potential 10 baggers you're spotting in your own life. If you found this video valuable, make sure you hit subscribe for more powerful investing wisdom every week. Share this with a friend who's chasing hot tips. They need to hear Peter Lynch's timeless strategy. And if you want the perfect follow-up to Lynch's lessons, check out Jack Bogle's classic, The Little Book of Common Sense Investing. It shows you how to pair Lynch's skill at spotting great companies with Bogle's foolproof system for building long-term wealth through index funds. Remember, great investing isn't about being the smartest person in the room. It's about being observant, disciplined, and patient enough to let your winners grow. Your next 10 bagger might already be right in front of you.